Picture the meeting. You're sitting across from someone, maybe at the bank, maybe a family friend who sells insurance, and they said something like this: "Whole life is better than term. You're covered forever. It builds cash value you can borrow against. When you die, your family gets the full payout tax-free. With term, you pay all those premiums and you get nothing back." They might have drawn a little diagram, maybe showed you a chart where the cash value grows over time. Here's the thing. None of that was technically wrong. But there is a number that wasn't on that diagram, and when you run it, it changes the entire conversation. I'm going to show you what happens to the premium difference between a whole life policy and a term policy in Canada, invested in a TFSA at a realistic market return. We're going to run the math they didn't run. My name is Nick. I'm not a financial advisor. I'm just someone who runs numbers on money decisions the financial industry would rather you not think too hard about. If that's useful, stick around. Let's start with what whole life insurance actually is, because the pitch makes it sound better than it is. With term insurance, you pay a monthly premium and you're covered for a fixed period, 10, 20, or 30 years. If you die during that window, your family receives the payout. If you don't, the policy expires and nothing changes hands. Simple, clean, no ambiguity. Whole life insurance works differently. Part of your premium goes toward the actual insurance coverage. The rest goes into a savings component inside the policy, the thing called cash value. That savings piece grows over time. You can borrow against it, you can surrender the policy and take it out. And your heirs receive the death benefit when you die, regardless of when that is. So why do the math nerds keep saying term is better? Two reasons. First, whole life costs dramatically more than term for the same coverage. Not 10 or 15% more. We're talking 5 to 10 times more, depending on your age, health, and policy. Second, the cash value inside the policy doesn't grow like a market investment. The insurer takes their fees, overhead, commissions, and a spread on that money. After everything comes out, the internal return on the savings component typically lands somewhere between 2 and 3% per year, maybe 4 in a higher quality policy. Not the 7 or 8% you'd historically expect from a broad market index fund over a long horizon. So what you're actually buying is insurance, plus a savings account, bundled together at a price that makes both parts worse than buying them separately. Buy cheap insurance for the risk. Build wealth through a different vehicle. The only question is whether the numbers back that up. They do. Let's look. Take a 35-year-old in Canada, healthy, non-smoker, wants $500,000 in coverage. For a 20-year term policy, that coverage runs somewhere around $40 a month. That number shifts based on your health class and who you're quoting through, but $40 a month is a reasonable illustration. For a whole life policy with the same $500,000 death benefit, that same person might pay around $440 a month. The difference? $400 every month. $400, that leaves your bank account either way. But with whole life, it goes to the insurer. With term, you could send it somewhere else entirely. Here's the question that should have been on that diagram. What happens to $400 a month invested in your TFSA over 20 years at 7% annual return? 7% is the approximate long-run average annual return for a diversified low-cost index ETF tracking a broad market. Not guaranteed, but historically reasonable over a 20-year window. The math: $400 a month, compounded monthly at 7% for 240 months. The answer is $208,000. Tax-free, in your TFSA, at age 55. Not a death benefit, not money that only pays out if you die. Money you own. Money you can see on a screen. Money you can use while you're alive. Now extended to age 65. Same $400 a month. 30 years, 7%. $486,000. That is the number that wasn't on the diagram. Here's the question the whole life pitch is designed to stop you from asking. Why do you need life insurance in the first place? The real answer? To replace your income if you die before you've had time to build wealth. To protect your kids' future. To keep the mortgage paid. To make sure your partner isn't left financially devastated. Those are genuine needs, but they have a timeline. If you're 35 with a young family, you need coverage while the kids are still dependent, while the mortgage is still large, while your income is the thing holding everything together. That window is maybe 15 to 25 years. By the time you're 55, your kids are likely adults. Your mortgage might be paid off or very close. And if you've been sending $400 into your TFSA every month for 20 years, you have $208,000 sitting there. The very problem that made you need life insurance, that you hadn't had time to build wealth yet, has been solved by the investment you made with the premium difference. The whole life pitch works because being covered for life sounds responsible, but most people's need for a large death benefit shrinks as their wealth grows. That's not a flaw in the strategy, that's the strategy working. Buy term, cover the years when the risk is real. Build wealth during those same years. By the time the term expires, the wealth takes over. Here's what this looks like practically. Figure out how much coverage you actually need. A common starting point is 10 to 12 times your gross annual income, for long enough that your family could replace your contribution to the household, usually 15 to 30 years depending on your kids' ages and mortgage timeline. A term insurance broker can help you dial this in. Use a broker, not a direct insurer. They shop multiple companies and find the lowest rate for your health profile. Get the term. Then take the premium difference between what term costs and what whole life would have cost and automate it. Transfer it into your TFSA every month, right when the premium comes out. No manual decisions, no willpower required. Inside the TFSA, put it in a low-cost, broad market index ETF through a self-directed brokerage. Keep the fees under 0.25% if you can. Don't touch it. That's the whole plan. Term for the risk, TFSA for the wealth. Nothing complicated. The pushback I hear most often sounds like this. But what if I outlive my 20-year term and then I'm uninsured at 55? Here's how to reframe that. If you outlive your term, you didn't die, which means the insurance worked, not by paying out, but by covering a risk that didn't materialize. And if you've been investing the premium difference for 20 years, you now have $208,000 in your TFSA. You've built enough wealth that life insurance serves a different purpose than it did at 35. You may not need $500,000 in new coverage at all. The goal was never to stay insured forever. The goal was to protect against dying before you had time to build wealth. If you reach 55 with a large TFSA balance, a smaller mortgage, and grown kids, you've accomplished that goal. The insurance was supposed to buy you time. You used the time well. This is a more serious objection. Your health can change. Some conditions make new coverage harder to get or significantly more expensive. If you develop something at 48, getting a fresh term policy at 55 might be difficult. That's real, worth acknowledging honestly. But consider what you're trading against it. To guarantee coverage for a future that may never require it, you'd pay an extra $400 a month for 30 years. That's an extra $144,000 in total premiums, while giving up $486,000 in potential TFSA growth. Most people at 55 with a strong balance sheet and grown kids don't need $500,000 in new life insurance. The risk exposure has changed. The coverage need has shrunk. Spending over $100,000 in extra premiums over 30 years to hedge against that scenario is a very expensive insurance policy on your insurance policy. For most people, the math doesn't justify it. There are situations where permanent life insurance genuinely makes sense, and I want to be honest about them. Large estate planning, where the death benefit is used strategically to cover a tax liability on assets you want to pass to your heirs. Business succession agreements, where permanent coverage is contractually required. Or a situation where you're diagnosed with something at a young age that makes you uninsurable going forward, and a permanent policy is the only way to guarantee protection for the rest of your life. Those situations are real. They apply to some people, but they are not the situation most people are in when they're sitting across the table being handed a brochure and a diagram. If you're in one of those situations, talk to a fee-only advisor who doesn't earn commissions on what they recommend. They'll tell you the same thing, but from a position that isn't financially motivated. For everyone else, the 35-year-old with a mortgage, a family, and 20 or 30 years of income earning ahead of them. Term, and a TFSA will do more work for less money than any whole life policy, every time. Here's what I want you to do right now. Pull up your insurance policy or find the proposal that's sitting in your email. Find the monthly premium. Then search online for what a 20-year term policy for the same coverage amount would cost someone your age. Take the difference. Drop it into a compound interest calculator, 7%, 20 years. See what comes up. That number is yours. It doesn't exist right now, but it's the number that was never on the diagram. If you found this useful, subscribe. Every week I run the math on Canadian money decisions that look small and turn out to be enormous. TFSA, RRSP, debt, investing, fees, the boring stuff that quietly decides whether you retire comfortable or stuck. No gurus, no hype, just math. The boring one wins.